Get ready for a wild ride. With rising interest rates and Fed rates causing the stock markets to suffer, the year ahead promises to be a roller coaster of ups and downs. But don't worry, we won't let the turbulence throw you off track. It's time to turn to the wisdom of the legendary investor, Peter Lynch. Lynch's strategies could be the key to navigating the stormy waters of today's market. With his investment philosophy emphasizing common sense and extensive research, you can position yourself to make informed decisions and come out ahead. So fasten your seatbelt and get ready for the ride, because with the right strategy, you can ride the ups and downs all the way to the top. But before jumping onto these tips, let us first see who is Peter Lynch and why his investing tips are so relevant in today's high inflationary situations. Imagine being able to achieve remarkable success in the world of investing, even during times of high inflation and market volatility. That's exactly what Peter Lynch, a legendary investor, accomplished during his tenure as the manager of the Fidelity Magellan Fund. Lynch's investment philosophy emphasizes investing in companies that are easy to understand, have a strong competitive advantage, and a potential for significant growth. His approach to investing was unique and effective, leading to an impressive average annual return of 29% during his tenure at Fidelity. The man who beat Wall Street, Peter Lynch, born on January 19, 1944 in Newton, Massachusetts, is best known for his 13-year tenure as the manager of the Fidelity Magellan Fund, one of the most successful mutual funds in the history of the stock market. In addition to his success as a fund manager, Lynch is also the author of several books on investing, including One Up on Wall Street and Beating the Street, which is one of the best-selling books on investing. So whether you're a seasoned investor or just starting out, understanding Peter Lynch's investment philosophy can be the key to achieving success in today's challenging investment environment. So without further ado, let's dive into some of the most valuable investing tips by Peter Lynch. Number 1. Do your homework. Stocks are not lottery tickets. There's a company behind every stock. According to Lynch, investing is like buying a business. And just like a business owner, an investor should thoroughly understand the company's operations and potential for growth. Peter Lynch believes that investing in individual stocks requires extensive research and analysis of the company's fundamentals. He advises investors to focus on the company's financial statements, competitive advantage, management team, and growth potential before making an investment decision. Investing without research is like taking a blindfolded leap of faith into a dark abyss. But by investing in what you know, you can shine a light on the path to long-term investment success. Extensive research and understanding of a company's operations, financials, and industry can give investors the confidence to make informed decisions even in the worst situations. Number 2. Hold the unseen hands. Peter Lynch's investment philosophy emphasizes investing in companies that have a strong competitive advantage and growth potential. He suggests that investors should not overlook non-visible companies, such as suppliers, distributors, and manufacturers, that play a critical role in the success of visible companies. Lynch believes that by investing in these non-visible companies, investors can gain exposure to the growth potential of the entire supply chain, rather than just the visible company itself. For example, if an investor invests in a supplier of a popular technology company, they can potentially benefit from the growth of the technology company as well as the demand for the supplier's products. Investing in non-visible companies can also provide diversification benefits and reduce the impact of any potential downside risks associated with investing in visible companies. Number 3. Play the long-term game. Lynch has said that, absent a lot of surprises, stocks are relatively predictable over 10 to 20 years. As to whether they're going to be higher or lower in 2 or 3 years, you might as well flip a coin to decide. It feels a little surprising to hear such words from a Wall Street legend, but it serves to highlight how fully he believed in his philosophies. According to Lynch, short-term fluctuations in the market are unpredictable and can often be influenced by external factors, such as political and economic events, which are beyond the control of investors. And Peter strongly believes that predicting short-term fluctuations in the market is not worth the time and effort. If the company you are investing in is strong, the value will increase over the period of time. And that is the reason why Lynch didn't try to market time or predict the direction of the overall economy. By playing the long-term game, investors can take advantage of the power of compounding and the growth potential of the companies they have invested in. Lynch advises investors to focus on investing in companies that have a strong competitive advantage and growth potential, and hold on to those investments for the long term to maximize returns. Additionally, playing the long-term game helps investors avoid the emotional traps of short-term fluctuations in the market, such as fear and greed, which can lead to hasty and irrational investment decisions. Can't research? No problem. Invest in mutual funds. Mutual funds are a great alternative when it comes to investments. Mutual funds are a type of investment vehicle that pools money from multiple investors to purchase a diversified portfolio of securities, such as stocks, bonds, and other assets. The fund is managed by a professional investment manager who makes investment decisions on behalf of the fund's investors, and the profits or losses are distributed among the investors based on their holdings in the fund. Maybe you are one of those investors who don't have the time or interest to do your own research about a company before investing in stocks. Peter Lynch has been a proponent of mutual funds for many years, as they provide investors with a hassle-free way to invest in the market without having to conduct extensive research or make individual stock picks. In his book, One Up on Wall Street, Lynch suggests that mutual funds can be a good option for investors who do not have the time or expertise to research individual stocks. Remember that mutual fund, Magellan, was Mr. Lynch's trademark success element. Mutual funds have historically outperformed stock mutual funds over a long period of time. However, Lynch also cautions investors to be mindful of the fees associated with mutual funds, which can erode returns over time. He advises investors to look for mutual funds with low expense ratios and to avoid funds with high turnover rates, as these can lead to higher transaction costs and taxes. What is an expense ratio, you may ask? It is the annual fee charged by the fund to cover its operating expenses, including management fees, administrative costs, and other expenses associated with running the fund, and it is a very important factor when it comes to considering mutual funds. And the last and most important, don't fear the loss. Peter Lynch's investment philosophy emphasizes the importance of accepting that losses are an inevitable part of investing, and that investors should not be discouraged by short-term market fluctuations or occasional losses. According to Peter, in the business, if you are good, you are right 6 times out of 10. You are never going to be right 9 times out of 10. In his book, One Up on Wall Street, Lynch suggests that investors should think of losses as an opportunity to learn and improve their investment strategy. He advises investors to analyze their losses and identify the reasons behind them so that they can avoid making similar mistakes in the future. He also suggests that investors should not be overly focused on avoiding losses at the expense of potential gains. It is a well-known fact that the fear of losing money can often prevent investors from taking necessary risks that could lead to profitable investments in the long run. So in summary, Peter Lynch believes that losses are a natural part of investing and that investors should be prepared to accept them as part of the process. By focusing on the long-term fundamentals of the companies they invest in and learning from their mistakes, investors can improve their investment strategy and achieve long-term success in the market. So that was it. Peter Lynch's investing philosophy, which revolves around investing in fundamentally strong companies with long-term growth potential and holding them for the long haul, while being patient and diversified in one's approach. I hope you found value from the investing tips shared by Peter Lynch. We hope they help you on your journey towards financial success. Remember, investing is a journey that requires patience, discipline, and a long-term perspective. Keep learning, stay focused, and always be open to new opportunities. Thank you for watching. We hope you learned something new today. If you did, let us know in the comments below. And don't forget to subscribe to the channel and click the bell icon. And we'll see you in the next one. Until then, I wish you the best of luck on your investing journey.